you have a new book out, A Template for Understanding Big Debt Crises. And Ray, to me, the underlying message of this book is that history is doomed to repeat itself. Have I got that right?
Yeah, everything happens over and over again for similar cause-effect relationships, right?
So, that sounds like an awfully depressing reality. Does it need to be a depressing reality?
Well, I mean, it's like any reality. You got to embrace the reality and know how to deal with it. There are debt cycles, and debt cycles provide great opportunities, and they provide real problems. So I think it's just like a progression, a disease that progresses. And the reason I wrote the book was just a compendium of research that I wrote mostly before the financial crisis. And it's because I think it's essential for everybody to understand the sequence of events, the logical sequence of events that makes these all the same. So, as you know, there's 48 of them in there. They all play out pretty much the same way, except there are inflationary and deflationary ones depending on the currency. But basically, I'm in 60 pages. I just want to convey that template.
So let's talk about one of those two types of debt crises, the inflationary depression.
Mm-hmm.
Is that what's playing out right now in Turkey, in Argentina, in emerging markets more broadly?
Yeah, certainly. And this has all played out many times. This isn't the first time that Argentina's gone through it. It has a habit of going through it, and it's not the first time it's happened anywhere else. So you could follow it. I mean, basically, the big deal is whether the currency is the debt is denominated in your own currency or in a foreign currency. And when it's denominated in foreign currency, like these countries have a lot of dollar-denominated debt, then they have a problem trying to service that dollar-denominated debt. When the dollar goes up and the money they're earning is in local currency, then they don't have enough cash, and then they get into that spiral, and as a result of that, they have to print more money, the currency depreciates, and it happens in a very mechanical way. Most of the countries don't have reserve currencies, don't have the debt denominated in their own currency, and as a result, most of their crises are of that sort. And there's a dynamic as to how they complete the cycle. In other words, what happens is when the currency goes down in value, essentially because of inflation and the like, they wipe out the local currency debt. If you own the local currency debt, you're wiped out.
You've evaluated 27 of these non-domestic currency crises in the book. So take what's happening today in Argentina, Turkey, and like I say, emerging markets more broadly, and compare it, if you would, to some of the things that we might remember. There are some people who are old enough to recall the peso crisis of 1994, the Asian currency crisis of 97, or perhaps the Russian debt default in 98, or the Argentine default of 2001. This looks most like what to you?
Well, it looks like that. It looks like those because the currency depreciation then also raises the interest rate differential. And in the process of wiping out the local currency denominated debt, because it's essentially monetized away, the currency becomes cheaper. All the crises are self-correcting mechanisms. So when the currency becomes cheaper, then it becomes more, the balance of payments improves because they can sell more or they import less. And also they begin to attract capital if they remain a healthy place for people to invest capital.
That's not happening yet. These countries haven't hit bottom, have they?
No, but they're, I would say, 2/3 on the way toward hitting bottom, I believe. And then what happens is, then it depends on what the monetary policy operates like, because the question will be whether those who are holding those currencies will receive an interest rate differential that will compensate for the depreciation in the value of the currency. And so the central bank at some point, sometimes through IMF support or sometimes through that other, just a tightening of monetary policy, has to create an interest rate that will offset both the inflation rate and the depreciation of the currency. And knowing how that mechanically happens is the means by which you can identify the bottoms in those currencies.
I see. When you say that to you, it looks as though they're 2/3 on the way toward the bottom now. Does that mean, is it as simple as saying that there's still a 1/3 depreciation left in their currencies before they're able to reach that point where they can, where the currencies are cheap enough to attract new capital and restore the balance of payments?
Yeah. Speaking as a generalization, I'm saying that they are, if it was placed out classically, what they'll have is large fiscal deficits. And how they choose to monetize those fiscal deficits, or how they choose to restructure their balance sheets through IMF loans or through the tightening of monetary policy, will be the determinant of the exact bottoms in those currencies, right? And so, but just generally speaking, the greater of the moves is behind us, the greater of the concern. We will have a lot of panic, more panic, and you'll have that. And as the saying goes, the time to buy is when there's blood in the streets, right? And to know when there's value, and those are the calculations one has to do.
Is there enough blood in the streets yet to see value?
I think we're getting there, generally speaking. And I think it's important also, that's that case of inflationary depressions. I think we should also think of the types of depressions that we go through, because I think that's also interesting.
Well, let's talk about that. We just lived through the aftermath of a big debt crisis, the kind of thing that you say in your book comes along every 70 years or so. But we're in the midst of another bubble. Is that we're in the midst of another cycle?
No, I don't think we're in the midst right now of another bubble. Let me maybe clarify. When you hit zero interest rates, you have a different type of debt crisis. You have more likely to have a depression. So I think the period that we're in is very similar to the 1935-1940 period. Let me just explain that in a minute. 1929 to 1932, we had a debt crisis and interest rates hit zero. Not 2007 to 2009, we have a debt crisis, it hit zero. Then in both of those cases, there's only one thing for central banks to do, and that is to print money and buy financial assets. They print money, buy financial assets in both of those times. That pushes financial asset prices up, puts a lot of liquidity in, and also contributes to a greater wealth gap, because those who own financial assets benefit when those who don't own financial assets. As a result, in both periods of time of the wealth gap and the economy not improving for a large segment of the population, we have populism. So the last time that we would say when was populism popular, it would be in that period of time. That populism issue is an important issue. So as we look forward and we say when the next downturn comes, which will happen probably in a couple of years, we're going to have a different type of downturn, very similar to the one that happened in 1937 to the 1940 period. We are in the part of the cycle now that the Fed and other central banks, in varying degrees, are beginning to tighten monetary policy. Asset prices are sensitive to monetary policy because the duration of those assets is lengthened. And so central banks have to be very careful not to raise interest rates much faster than is built into the curve. But with that populism, we have an issue. So if we think about what the next downturn will be like, the downturn, I think, will be very different than the one in 2008. It'll be one in which I think that the social and political problems will be great because of that wealth gap and populism. I think there'll be more conflict. Right now, times are good, and we're sort of at each other's throats in that. I also worry about the effectiveness in monetary policy in reversing that, because monetary policy has interest rates, and we can't lower interest rates as much, and it has quantitative easing, the purchases of financial assets to push other financial assets out and get liquidity into the system. And that is at its maximum. So when we have a downturn, we're not going to have it to be as effective. I think also the downturn in our form of debt crisis won't just be debts. It'll also be pension obligations, healthcare obligations, unfunded obligations.
So
and I think one more thing, and I think it'll be about us having to sell a lot of treasury bonds to the rest of the world, and I think that that'll also be an issue about 2 years out. So I would say 2 years out is when I'm worried about, and I would think that that's for these various reasons.
Speaking in financial terms, if we look at what you're saying through the lens of the markets, how bad is it likely to be relative to what we went through in 2008, 2009?
Oh, I don't think that it's going to be as sharp and severe like that. I think it's more going to grind on. And I think all of these obligations will be a problem to be funded. And I think it'll be more back there of a dollar crisis than it would be a debt crisis. And I think it'll be more of a political and social crisis than a big sharp haircut. Well, when we have to sell a lot of treasury bonds to the rest of the, we have to sell a lot of treasury bonds. And we, as Americans, will not be able to buy all of those treasury bonds. And if interest rates rise too much, the way it usually works is that constricts credit. We borrow less, and that creates a weakness in the economy. So instead, because we'll sell to foreigners, from a foreign perspective, when they look at it, they care not about inflation, they care about currency depreciation when they look at the interest rate. So if a currency goes down, the bonds become cheaper. I think the Federal Reserve at that point will have to print more money to make up for the deficit, have to monetize more of and that'll cause a depreciation in the value of the dollar. I think we risk, we have the privileged position of being able to borrow in our own currency because we have the world's leading reserve currency. I think we are risking that by our finances. In other words, borrowing too much. And you can get to the point where, others, when you own a bond in a U.S. bond or in any particular currency, you're getting a pile of that currency.
By how much could the dollar go down?
Well, you could have, you easily could have a 30% depreciation in the dollar through that period of time. It depends how long, 30%, I would say.
Ray, some people say that, to borrow Ken Rogoff's terminology, this time is different. That because the post-crisis recovery was so slow, because we've had a massive tax cut in the United States, because the Trump administration is deregulating the economy, that GDP growth is going to keep on accelerating, and that a downturn or a recession is many, many, many years away, not 2 years away. I take it you don't agree.
I just do the calculations, and the fiscal stimulation that we're having is coming at a higher rate of capacity utilization, a higher rate. And so we're getting that stimulation at the late part of a cycle, and that's what we're having. And that's a stimulant that will last for particularly.
It feels good, right? Wages are rising, the unemployment rate is at a record low.
Feeling good is not an indicator of the future. Euphoria is bubbles are made of euphoria, by the way, so they feel the best, right? But I'm just doing the calculations, and what I'm saying is that right now the fiscal stimulus is coming in, and that's good. Productivity is enhanced by corporate tax cuts. A lot of money is going to the companies. They have lots of cash. That is good for the time being. If you do, when that stimulus passes through and then diminishes, that diminishes in about 18 months and 2 years. But the borrowing doesn't. So the borrowing will be in the marketplace about that time. I'm not trying to be precise as to exactly what year or what month that has. I think we're 9 years into the cycle, and the cycles are the cycles, and the balance of payments and supply, demand, and credit is what it is. And so I'm saying that we're probably in the 7th inning of this game. And therefore, I'm not particularly worried at the moment. But if I was to take, as we get to the 9th inning of the game, then we're going to be.
How do people apply this?
And the important thing, I think, is not even what I think about this. The important thing is for you and each person to really study how these cycles work. In the book, we show how all 48 of the cycles over the last 100 years that were significant followed the same path. So for 60 pages of reading,
I want to interrupt for just
you
a
can
moment.
get that. And by the way, I'm making it free so that everybody can have it.
And that's an important point. People can download a copy of the book on your website, principles.com. But Ray, one thing I want to ask, people go, download the book, read it, analyze it, understand. What you can help them with is application. If you're right, if we're seventh inning into this ball game, the downturn is 2 years away, what do you do? How do you invest? What's prudent?
Investors have a choice of whether they're trying to be active investors in market time, which most of them are not going to be able to do well. That's a professional's game, and it's tough to do it as a professional. And then there are emotions and all of the things that enter into that. So I would say that, generally speaking, they should not be actively trying to invest, or if they do, I would not recommend it, but if they do, then they have to go opposite their instincts. You know, buy when the blood is in the streets and sell when times are good. What I would say is important, just like we were even talking about prior to the show, is to be able to have know how to have balance in the portfolio, know how to achieve that, because each market performs as a reflection of the economy at the time, and all of the economy's characteristics keeps changing. There's inflation and deflation and all that. Balance is key.
Let's look at a single best chart right now. We usually would do this sort of arithmetically for Nicholas Lardy, but Adam Posen said, no, Tom, go log with Nick Lardy. It'll always be wonderful. Where slope matters. We've seen this slope before in the 90s, Nick Lardy, but that was a different time. This slope is persistent. It's got an oomph to it. Is it a good slope of a maturing economy, or is that a problematic slope of GDP in China?
I think it's problematic. I don't think it's the natural result of a maturing economy. That's one argument. But China is very large in the aggregate, but in per capita terms, it's still relatively poor. There's tremendous remaining potential for convergence towards higher levels of industrialized countries' per capita GDP. So I think it reflects the greater and greater interference of the party and the state in resource allocation. The productivity of state firms has declined by about 3/4 since the global financial crisis.
Are they still glued by the red phone? All the fancy government firms have the red phone. They're either calling Carl Weinberg or 1-800 President Xi or 6 other people. Is the red phone still predominant?
I don't know. They're not calling me Tom.
No, but the answer is the red phone is an important symbol of what Nick Lardy's talking about.
Yeah, I don't know. I see the state shrinking as a share of the economy. I see state-owned enterprises, state-owned banks having a smaller share in all of their sectors. To be fair, if a company gets a lot of subsidies to increase its productivity in a specific sector, like pharmaceuticals or high-tech cars or something like that, then the question is, how strong is the state intervention going to be? And I don't believe that companies in China can survive on a purely state-owned basis as we move forward. I think that they have to yield to some capitalism in order to be able to compete with the capitalistic companies around the world. So I think that the statism, to me, is a fading influence. To me, the slowing growth is more of a demographic factor. You know, the demographic dividend pays less when you're moving 25 million people a year from the farm into the city. It pays less of a dividend when you have 600 million people in the cities than when you had 400 million people in the cities. And that's a secular slowdown in the growth rate.
But, Carl, this is not the kind of slowdown that we saw in 2014 where real estate collapsed and actually the government had to put extreme stimulus in, right? It's a different kind of slowdown.
Yeah, it's a different well, what we're seeing right now, you know, you say slowdown, Francine. I look at the chart and I see China growing at 6.5%, 6.75% for the last 4 years. And there's a tiny little bit of a slowdown when you look at the percentage changes. But overall, growth has been pretty constant within China in this range. It's slower than what they want, but certainly quarter to quarter, there hasn't been a substantial decay of growth. And more importantly, there's not an alibi in China's growth story for American companies that can't sell and increase their sales in China. The economy is still growing at 6.5%, and that's huge, and that's hugely faster than most other markets that these companies are trading into. If they're having a problem selling X, Y, or Z in China, they have to look within for their problems, not to the economy.